Hello friends, welcome back. Just wanted to have a quick review of where we are in these cycles. This is a SPY chart, as you can see, on a daily time frame. And then we also have some other indexes tracking the overall market movement. As we have been saying, we are bullish, mildly bullish, since November and March time frame, and you can see market is drifting. One quick way to identify the drift and the direction is you see these lines at the bottom. They can give us some precursor signals towards the impending directional move. As you can see here, that this fat green line is a slow anchor tracker. Now, relative to that anchor, we have the red line or magenta line, which is faster than the anchor line. And then we have this yellow line, which is much faster, and it pretty much is chaotic, and it traces all the wiggles, peaks and troughs in the movement space. Now this is a probability framework that the expectation is set as these things move away from each other and they cross each other. To demonstrate that, so here is an idea where we can see that the anchors shifted their direction. The yellow one followed by magenta one. So yellow will always move faster than the other ones, so giving us the hint that this could be the bottom put in the financial markets, which basically dictates all the sectors and the sector rotation and how the policies are impacting your market. Now that we understand the framework of movement, let's see what it is showing. Same pattern, as you can see, is also visible here, where we had 22nd last year, bottom put in place. Here, bottom put in place, and here, bottom put in place. So these moments in time gave us the impulses of the market movement. There are a lot of patterns here to talk about, but you got the idea that this structure of how the independent relative locations of the stocks, which are displayed below, are giving us the hidden messages how the composite, which is your SPY ETF, or you can use SPX, it should not matter, this is daily chart, right? They are both derivative, SPY, ES derivatives from SPX, right? They have relationships. So the main fundamental idea is that this gives us an opportunity to have some probability biases known where the big movements are coming, so we can make our business decisions accordingly. And this is where we were saying we are bullish because that's how sentiments were at this point. And same thing as here when we reiterated our bullish tendencies. Now, how about the endpoints? The drift can go on 6 months, diverged from the projected endpoints. We have to use other deep cycle methods to handle those. But here, just to show that the interaction, the anchor is anchor for long term. The shorter contangos between these two lines can also give us some probability to cut down on your risk. Now that can just last for 3-4 months, which is fine, but you got the point. So as you can see here, these are the contango points where we saw some potential. Now we also have ways to measure the moves where the endpoints are based on the circle, square, and ellipsoid methodologies, but just as a keen observer, you can see how these endpoints, if there is a very extreme high volatility between these two lines and they diverge very fast and they move relatively fast, you can expect some snapbacks at the levels we can see here at levels of 90 or 100. So when this guy reaches the level of 90 plus, as you can see here and here, and crossover happens as well, you can see some pullbacks. You can see some slight pullbacks showing up as well. How much will they pull back? That again is a different science to work with, but you got the idea that we have the endpoints exposed at these critical levels. The pushback, as you can see, are coming, impulses are showing up. And this is one of the patterns which we can say that you are coiling the energy in this space like this, right? And we are expecting it will break out of this coiled energy in one way or the other. So this can also help us that, hey, look at this bias. We are on the lower side, and then if crossover happens, we can expect a move giving us an probability to take a bias in that specific direction for a long-term hold. Long-term hold means multi-month holds. You can see here the patterns are showing up. Just to see that, now you can see that as well. Here the patterns showed up on the bottom side. So coming from the bottom, lift off, we are dealing with this, how we have moved very aggressively away from the anchored green line, giving us the bottom probabilities. This extreme boy, when it gets to the extreme, gives us snapshot probabilities. As you can see, but it doesn't tell you how far it, or it doesn't have too much power, but it does have probabilities alignment for sure. As you can see, we can go back hundreds of years and the patterns will show, but we're dealing with raw structures of data. Just wanted to show that, and hopefully this helps. Right now, again, we are in a situation where we are starting to get some pullbacks, and this anchor line is moving in the direction where this itself becomes extremely at this very high end level. When this happens, you can expect a pullback. So this is where the things are interacting. They are in a situation where we might get some pullback in coming months, but if you want to just keep adding long-term positions, keep on adding and adding. So these are the add. So let's say you buy 1,000 shares here, 1,000 shares here, 1,000 shares here, 1,000 shares here. Every time you get a pullback, you keep on adding to your long-term portfolio. If you're managing a 401k, you can do the same thing. You wait for these positions before you put in your 401k or Roth IRA or long-term analysis, so you can time your entries if you are self-managing your portfolio, because we know these dips and we buy these dips when we get little advantage over the public who is averaging in all the positions. We only go in at the great pullbacks, right? We only buy it at the great pullbacks. So you get 2-3 pullbacks, great pullbacks a year. This is where you can strike your 401ks, IRAs, and you can keep on adding those positions. Now nobody's stopping it that this guy can go all the way down here, right? In 2020, I don't think it's possible in this market, but we are playing with the probabilities. Nobody's stopping us that it'll go down here or not. But this is a very interesting situation where you can see the crash in 2020 came with everything came down to almost zero. So this one pattern space gives you all the information you need to track effectively how the cycles are working. And once the bullish trend dominated with Fed injections, as you can see, all these areas were pulled back by areas. So you can buy here, you can buy here, you can buy here, you can buy here before the crash. And you can also notice that before the crash, everything lined up to very high. And this is what I was trying to say. They can go into this drift for 6 months before they really take things down. So this going short side of this is a little challenging, because pullbacks are easy to trade because there's a natural drift in the market. But the problem becomes when you treat this as an indicator and say, oh, this is everything is on 80 or higher, let me short. But they can go against you, because this is what they do. They trap all the people in excitement and they wham. So because since you're long term, this is good strategy for a long-term portfolio building. And same thing here, right? The patterns are showing up. You can go back hundreds of years, it doesn't matter, right? Cycles of interest, natural pullbacks of interest. So you can see here, same thing, it was trying to pull the market down, it just went a little bit dip, not much. So picking the tops are challenging because of this, because the excitement can run over much longer, bullish trends can run much longer. So just cannot trade this as overbought, oversold. It's a tactical positional framework, and then you have to use other advanced techniques. We are aware of that. So all right, so for that reason, since the drift was down, you can see the green line drift was down, the pullbacks shorts were working very nicely. Here the drift has taken from here, drift is going down, up, drift is moving, this big anchor drift is moving, the green fat, it takes a lot of money to move it. So it doesn't really, it takes a lot of money to move it. It doesn't dip right away. When it does, with this huge panic, when everybody is selling, this is going down aggressively. And those are the great moments to buy. Drift has moved up, and these are natural rotations, pullbacks into the drift. Drift is moving up naturally, pullbacks into these areas, as you can see. I hope this helps, because why you need to know this is because when you see this, where we are, you can plan your 3-month, 6-month cycles and say, okay, what is going on? Now this is on daily chart. Now if you do this cycles on weekly and monthly, that will release a multi-year phenomena and what's going on. And that's it for now. Thank you so much.